Hi, this is Matthew Cratter from Trader University, and today I want to talk about whether we are at the end of the bear market. If you're worried about this stock market or just want to see what I'm trading and continue to get my updates on YouTube, be sure to hit that subscribe button. So today was obviously a very strong up day, and I've been getting a lot of emails from people saying, is the bear market over because of this? We had Apple up more than 7%. We had the financials like Bank of America, JP Morgan just up a huge amount. Amazon was up 5%. And all of this on the back of Trump telling his party, telling the GOP that he wants the payroll tax waived through the end of the year, essentially through the election. And then lots of other talks about fiscal stimulus packages. So what a lot of people don't realize is that very big up moves like this are almost never seen in a bull market. And when you see big daily up moves, what I want to jump out at you is I want it to be a reminder to you that you are most certainly, or most probably, very high probability in a bear market. So let's go back and look quickly at changes in the Dow Jones Industrials. We're going to look at daily changes, and we're going to look at the dates associated with them. So over here we have percentage changes, and then we have the dates. This is just from Wikipedia. You can see that two numbers really stand out, both of them from October 2008, so sort of the heart of the financial crisis, about a month after Lehman Brothers filed for bankruptcy. You can see that we had days there where the Dow was up 11%, a little more than 11%, and almost 11%. The rest of the days, number 2 is 1931, in the heart of the Great Depression after the great stock market crash of 1929. We have another big up day. This was, I believe, a few days after, I think the stock market crash, October crash of 1929 was mid-October. So 1929, 1932, I think by 1933 the stock market had bottomed. So near the end of a very long down move, you can get some big up moves that may signal a reversal. Let's look at so that was for the Dow Jones Industrials. Here we're going to look at largest daily changes in the S&P 500 to see if we can find something analogous to what happened today. And again, the top, call it the top 6, we have the 2 representatives from October of 2008. We have 1931, 1932, 1929. These big daily moves, and you can see they're actually bigger than what we got today, much bigger than what we got in the S&P or the Dow or the Nasdaq. We got double-digit moves back here in 2008. This was the heart of the bear market. The stock market indices globally and in the U.S. did not find a bottom until March of 2009. So investors still had really 5 or 6 months of extreme pain ahead of them at this point. And so what happens is bear markets are very, very, very difficult to trade for this reason, because if you can look around and say the financial system's collapsing as it was in 2008, or there's a global pandemic as there is now and everything is shutting down, so you know that things are bad. You see the stock market going down, and so you want to short it. You want to bet on it going lower. But what the problem with bear markets is they're very difficult to trade because of this high volatility. So it's very hard to be short a market where you can have a daily move where these trillion-dollar companies are up 6, 7, 8%. And so it makes it very difficult to short. You have to time your shorts very, very carefully. And it also makes it very difficult to be long, simply because the market is moving down and down and down over the weeks and over the months. Now, one way of seeing that we're in a high volatility regime is all you need to do is look at the VIX. Now, the VIX is a measurement of S&P 500 options that are about 30 days from expiration. It's the market's best guess of the forward volatility, the volatility that's going to take place over the next 30 days. And this sort of forward or implied volatility usually keys off a present or trailing couple week or couple month volatility. So a high VIX tells you that the market is expecting volatility going forward, and it's telling you that the market is very volatile right now. So my answer would be that we're definitely much closer to the beginning of this down move than we are to the end. And depending on, I obviously don't offer financial advice here, you need to talk to a personal financial advisor. But if you feel you're overweight in equities, and after consulting with your advisor, you feel you want to get out, these kind of days are very good for unloading your positions. If you unload on a day like Monday, like yesterday, when everyone is selling, you're not going to get a very good price. But if you wait for these sort of, they often call dead cat bounces or dead cat market bounces, and you can see we had one on February 28th, where the market moved up for, call it 1, 2, 3, 4 days, essentially a 4-day move. And now we've had basically a 24-hour move much higher. What happens, and what tends to discourage people and make them eventually want to get out of the market in a bear market, is they get seasick from all these giant moves. And there's a tendency for new investors or new traders to get very excited when the market has a big up day like this. But especially if the bear market hasn't been going on for 6 months, 12 months, 18 months. In my experience, especially my experience of 2008 and 2009 and 2000 and 2002, these are the kind of days when, if you're overweighted in equities and you want to get up and get out and sort of lighten your load, these are good days to sell into, because inevitably the market rolls back over, as it did at the end of February, and as I would expect it to do probably in the next couple of days. It's hard for me to see how the market can go higher in this backdrop where the news headlines are just going to be relentless. Hundreds of thousands of Americans and people worldwide, probably millions of Americans eventually being diagnosed with the coronavirus. Now, it's not serious for everyone. It's more serious for people with chronic health conditions and people over the age of 50, or a combination of those two things. But it's going to be very hard for the market to make progress against this. So another trick I learned in the 2008 bear market is I was very aware of the financial situation that was going on, and I had some advance notice that the banks were going to start collapsing. The hedge fund that I worked for was really on top of this, and very on top of the housing bubble. And so I was trying to short the market, and I was just getting really shaken by this volatility. And then someone taught me that the best way to trade these financial crises or these bear market panics is just to be long treasuries, to be long dated treasuries. So the two ETFs for that are IEF, which you've heard me talking about quite a bit over the last, really since the beginning of the year, IEF and TLT. Now I like to use the futures for these, the TY or the TN, or you can use the long bond. I certainly don't recommend futures for people who've never traded futures before, and especially in this environment. It's very, very dangerous. But what this is a bet on rates going lower. So you can see the 10-year note yield, it's just crazy. It bottomed at 0.4%, and today it closed at 0.75%. This 10-year government sovereign bond yield is negative all across the world. It's negative in Japan. It's negative in a lot of European countries. I think in almost all European countries. And so I'm expecting these yields eventually to get down to zero, probably before summer, just in the next couple of months. So there are two ways you can trade a bear market. You can try to short the stock index futures or short individual stocks, but it's very difficult to be short stuff when you get these moves where the market moves against you by 5, 6, 7, 8, or even heaven forbid 12 or 16%. And so the smoother, the more low vol way of trading it is to be long treasuries and to be betting on lower rates. So I'm still long treasuries. You can see IEF, we finally got a nice pullback here. For those who think this might be a good trade for them, and again, consult with your own financial advisor. This is a nice pullback, I believe, to add to positions. I'm also long gold and long Bitcoin, and these tend to be Bitcoin is certainly not smooth, but will benefit from government central bank printing, and so that's basically my conclusion. When you see this kind of really high volatility, and you can just see it on the chart. Actually, if we look at The other sign is just the huge spike in volume that you get. So you can see during a bull market, the volume is fairly low. And you do have, little sell-off episodes like the last summer, but volume is much higher in a bear market. And this is why it's good for futures exchanges. It's good for places that charge a commission or a fee to trade, but it's really bad for everyone else. And so whenever you see a big up day, I want your gut reaction or your reflex to be, this sounds a lot like a bear market. And especially when you look at a chart and you see just really heavy volume trading, that's another sign of a bear market. And in my experience, once one of these gets started, it's like a giant cruise ship or a giant truck. It's very hard to turn when you're going at a certain speed, and it's very hard to stop. And so I personally would not be, again, not investment advice, but I personally would not be in a rush to accumulate equities. I think prices are still much lower 12 months from now. And so there's really no rush. There's no reason to try to trade stocks in this kind of environment. Unless you traded in 2008 and 2009, I'd be very careful. Or if you are going to trade, size your positions very, very small, because the moves are bigger. You actually don't need big positions when you get really big down moves like we got on Monday and very big up moves like we got today. All of which is to say, I expect this market to roll over. I think we're going to see new lows. And I think this situation gets a lot worse before it gets better. If you found this video helpful, make sure you hit that subscribe button. Let me know your thoughts in the comment section below. Hope you guys all stay healthy out there, stay safe, be very careful wading into these markets, and I'll talk to you in the next video.